A few years ago, two friends, let's call them Raj and Aman, both had the same amount of money saved up, 10,000 rupees. Both wanted to start investing. Both were equally excited. Raj went all in on stocks. He picked one company he'd heard was the next big thing. Aman didn't know where to start, so he just put his money into a mutual fund and forgot about it. A year later, they met again, and what happened to their money will completely change how you think about investing. Stick around, because by the end of this story, you'll know exactly which path is right for you, and it's probably not what you're expecting.
Jake was confident. He'd watched a few YouTube videos, read some headlines, and picked a company everyone was talking about. For the first 2 months, the stock shot up. He felt like a genius. He even told his friends he was going to be rich by 25. Then came the crash. The company missed its earnings target. The stock dropped 30% in a week. Jake panicked. He didn't know whether to hold or sell. He checked the price every hour, lost sleep, and eventually sold at a loss, right before the stock recovered a few months later. That's the reality of stocks. When you pick individual companies, you're not just betting on numbers, you're betting on your own nerves.
Mike, on the other hand, did something almost boring. He put his money into a diversified mutual fund and set up a monthly automatic investment. He didn't check it every day, he didn't panic during the dips, he didn't even notice happening. A professional fund manager was quietly spreading his money across dozens of companies. Some did well, some didn't, but the overall basket kept growing steadily. A year later, Mike's investment was up. Not explosively, not a dramatic story, just quiet, consistent growth.
Here's the surprising part. 2 years after that, Jake tried again, this time smarter. He kept 80% of his money in mutual funds for stability and used the remaining 20% to invest in stocks he'd actually researched properly. That one shift changed everything. He got the steady growth Mike had, plus the chance to grow faster with the stocks he understood well. No panic, no sleepless nights, just a strategy that actually made sense.
So here's the answer you might not expect. It's not stocks versus mutual funds. It's stocks and mutual funds, used at the right time for the right reason. If you're just starting out, mutual funds give you a steady foundation without needing years of market experience. Once you understand how markets move and can handle the ups and downs without panicking, that's when individual stocks become a smart addition, not your entire strategy.
Jake learned this the hard way. You don't have to. Start with a strong foundation, build your knowledge, and only then take bigger risks, with money you can afford to lose. If this story helped you understand the difference, hit like, subscribe for more real, no-jargon finance content, and let me know in the comments, are you more like Jake or more like Mike?